Welcome everyone, let's get it. The Liquid State Trading YouTube channel. Who's excited? I am. Nah, but yeah, for real, I just wanted to make this channel to basically give out some insights into kind of supply and demand, SMC, institutional trading, whatever you want to call it. I don't really like the term institutional trading, but you know, that's what gets the most views and the most clicks, so maybe I'll have something like that in the title. Yeah, so this one's going to be about supply and demand zones, basically, and the fractal nature of them going down through timeframes. Now, there are kind of several confluences which you can look for in a supply-demand zone, which make a good one. They're all on the left here, just for ease of access as we kind of go through as we're going to go through stuff in this video. Now, I'm not going to be demonstrating any entries or any kind of advanced low time frame stuff right now. This one's just to start off simple and get a kind of basic idea of what you want to look for in supply and demand zones, and I'll continue updating it with lower time frame stuff from there, and yeah, building up a kind of overall holistic approach as we go through multiple videos. Now, yeah, so for this first one, I just want to explain basically the basics of what you should look for in a POI or a supply and demand zone. Now, first up, you want a pro structure. So we'll just map it out. Currently, this is our 15-minute swing leg. This high down to this low, since we break this low here with a body close, as you can see. So looking for any kind of trades short from POIs within here makes sense. Now, there's other stuff at play here. On the higher time frame, we've tapped into a demand over on the left, which isn't visible on the 15-minute. But yeah, there's also not many confluences for these POIs, so let's just have a look. So pro order flow. Now, order flow is a bit different from swing structure. It's kind of the first little high to go to consider a change of trend. Now here we get this low, and then we get this inside bar high. So this would be my 15-minute change of character. If this goes, and then pro order flow will be anything within the new leg which is created here. So any POIs down here, we trade them long potentially, but we are bearish on the 15, so just bear that in mind. You don't want to shoot for the stars. Now, so that's pro structure and pro order flow. Now, extreme POIs is they're basically just the extreme point of price within a price leg. So here we can see it would be this candle right at the top. Now, it does get partially mitigated, like to the 50% pretty much. So the only kind of supply within this candle left is this wick up here. So this is the extreme of price. So yep, this is a valid kind of supply zone up here, and you could say that it basically could use this wick as inducement, which I will just go over now. Yeah, so one of the confluences is it has inducement, which is this high built right above it right here. So yeah, pretty simple kind of concept, but very complicated by the supply and demand kind of sector, I suppose, or SMC, whatever you want to call it. But yeah, it's simply just a point of liquidity resting under or above your POI of choice that you want to trade off, basically. So that's extreme. Now, interaction would be a supply and demand interaction. Now, the most obvious one right here is there's a point of demand here because we break a little high right there. So as you can see, when price comes back down into it, we push up and then we fail the demand. So this would be a supply to demand flip, so which is interaction. So this POI has interaction right here. Now, sweeps liquidity it's another kind of part of, or it's similar to inducement, but more like, yeah, we've swept the inducement rather than it being presented to us. So yeah, so this would be inducement. It's minor because it's not structural. So this high up here doesn't break this low, so this would be minor inducement. But let's find this is a good one. So we've got these stacked highs here. kind of relative equal highs, and they break this low here. So this is structural inducement, and as we can see, we get a very aggressive sweep above it, which taps into effectively these wicks, these unmitigated wicks on the left, and then we start pushing lower. So yeah, that's an example of a liquidity sweep. Supply and demand chain. So this is kind of following order flow and how it kind of presents itself in the market, and mitigation to mitigation of kind of points like large orders in the market. So let's find a decent example. So here we have, this isn't great because it doesn't break any structure, but this would be an internal respect of supply here with a small sweep. So we respect it, we push lower, and then we flip off some demand within this leg down here, and then we eventually tap into a supply on the left again, on the right. So we tap in, push lower, make a new supply zone out of this kind of area. We tap in again, and then we push lower. So yeah, this is a decent supply chain starting from here, and then we just keep building them to push price lower eventually. So mitigation to mitigation, it's basically just following the mitigations, ideally with sweeps included, just so you stay on the right side of the liquidity profile, and yeah, following them down. Next up, we have we went over inducement. So pricing, yeah. So when I'm looking at a leg of price, swing structure or internal structure, I will draw a Fibonacci tool. So this one right here with a 50% line on it, and this will tell me the pricing of any kind of trades that I might be taking. So anything above this line is in the premium, so you want to ideally sell because it's well priced to sell, and it's expensive to buy up here. So, and the same is true for the discount. So ideally buys below the 50% and sells above the 50%, which just keeps you on kind of the right side of expensive and cheap places to buy and sell. Now that's, oh, and finally we've got the engulfed candle. So this is a really good example of one. We've got a buy candle which gets completely engulfed by the body and the wick. Well, it needs to be the body that engulfs the bottom of the sell candle, but yeah, as we can see, that's what we get here. This is another good example of this whole candle up here, which is basically like a doji, and then we can see it gets engulfed and then tap into it again and push lower. So yeah, that's all your confluences. Now take some notes, write down whatever you want to write down out of these, and I will go over some live chart examples now. So right away we get our change of character. So now any POIs within this leg of price up to here is like these are pro order flow at this point, so we can potentially look for trades off them, although there's no liquidity profile for any of these POIs yet. This is the most obvious one. Let's see what happens. Okay, we just kind of mess about now. Okay, now what we can see that happened here is basically we come down, we swept this liquidity, so we sweep this here, and then we change character when we take out this high again. So our order flow is realigned with structure since we've broken our swing high over here. So our swing structure would now be this. Anything well priced would be below the 50%, which is this, and well, for looking for buys, and anything when you're looking for sells, it'd be above the 50%. So as you can see, we just tapped into this, but the expectational order flow says that we should take out this high now, following, since we've got our bearish leg and our bullish leg, so we're likely to take out this high. Now we can see some kind of demand chain forming in here as well. So got this candle, gets respected by this candle, which actually also has a minor sweep within it. So we sweep the low here, respect the demand range, push up again, We leave a little bit of inducement right here, which again gets swept into this candle. Continue the demand chain. If we just look at the confluences for this zone, we can see that first up it's pro structure. You have to excuse my poor typing, but it's also pro order flow. It's not an extreme because we react off this supply here. It is a flip, so we come up and then we flip, pushing higher. So it's interaction, sweeps liquidity. It's part of a demand chain. It doesn't have inducement, but it is well priced, and it is also an engulfed candle. Okay, so literally this one candle here, this one POI has all of these confluences, which is like 1, 2, 3, 4, 5, 6, 7 out of 9. But it can only, so yeah, it can't be both. It can't be both of an extreme or interaction because they're different. They're different things. Now, this, yeah, as I was saying, that would be a great place. Maybe you could enter off the 50% of this candle with your stop loss underneath. Obviously, as I was saying, I don't enter on the 15M. I enter on the lower time frames, such as the 1M or the 5 seconds. But if you were to just for simplicity's sake and reference, if this would be a great place to enter on the 15M if you were to, and targeting the high to get taken out as its pro trend. Now, we've actually seen a couple re-entries here now. This could be a potential re-entry, although it doesn't have inducement, so you might want to wait for inducement to be built, which gets built after we tap into it. So this is the demand chain that's getting continued here. This candle gets mitigated by this candle, and then this candle gets mitigated by this candle. Now, this candle creates inducement above it, so this would be a good candle to enter off if you wanted to re-enter into the long position. Again, not going down on a low time frame, just using 15-minute for simplicity's sake. But yeah, that would be your two nice high probability trades for this session or this day. And yeah, and then this would be our last point in the demand chain, this kind of POI down here, but depending on what we get, what kind of price action we get afterwards, it might not get tapped. So yeah, instead we basically just see this whole demand range get tapped here, and then we would have had a break of this high, which brings our order flow back in line with the trend. So at this current point, we're still bullish, but this is our swing low to the swing high, and this would be our 50%. So the only thing with buys here is ideally you want it to be below this line, but the only one which is, yeah, it taps basically into this this flip here before pushing higher. Now, this isn't well priced on the 15 minutes, so you could easily miss a trade here, which is fine. But yeah, just as it doesn't have as many confluences, so if we look at the confluences that this has, it's pro structure, it's pro order flow, it's an interaction, it doesn't sweep any liquidity, it's part of a demand chain, but like indirectly. The direct demand chain would be this here, but this is indirect demand chain because it's come off it, but it's a flip rather than the extreme that you're playing. So that's something for another video, though. That's a bit more complex. It's not that well priced. Like, a part of it is in the 50%, but more than half of it is above, and obviously it doesn't come down into the price, doesn't revisit the 50% anyway, it just shoots off from here. And the engulfed candle is actually this, but it doesn't fully get tapped, so we can use the start of where price started pushing down from this high here. And that is just kind of how I look at supply and demand zones and choosing the right ones, or the most high probability ones. Yeah, I mean, again, here we see a new 15-minute range created. We've got this candle that flips off this high here, uses this as inducement, And yeah, if you wanted to, again, I don't enter off the 15-minute, but if you were, that could be your entry. Slightly less probable because it's not quite in the discount. We just barely miss it, so yeah, that's one thing against this trade, but it does end up playing out, and we take out the high as assumed. So yeah, it's just kind of applying these confluences down here, as many as you can per zone, and waiting for the good ones so that you don't take losses on unnecessary zones. So like here, the continuation would have been very difficult to get into, and it's not high probability. Well priced is all the way down here, but it ends up kind of tapping these sell to buy wicks here and pushing up higher. So, and this might get used as inducement for later because it's not very well priced, but yeah, so it's just about applying as many confluences as you can and waiting for the good stuff, really. So yeah, this is kind of an insight of how I just look at supply and demand zones in a basic sense, and I like looking for the most high probability ones in a market. So I'm going to leave it there because I've already kind of suggested all of the points that I look for anyway. So yeah, that is going to be it for the first video. So thanks for watching. Yeah, if you like the video, hit that big bad like button and subscribe if you want to see some more in-depth, detailed and intricate trade related knowledge. So yeah, it's your boy Liquid State Felix, over and out. Nice one, guys. Have a good one.